And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Welcome to the Real Investment Show interview series, and today's our special guest is a very dear friend of mine. I've known Daniel for years, and we followed each other historically, and have just a very brilliant gentleman, Daniel LaCalle, who is, of course, the professor of global economics at the IE Business School. He's also a fund manager with Drizza International Opportunities and the author of bestsellers like Life in the Financial Markets, The Energy World is Flat, and Escape from the Central Bank, which was translated into Portuguese, Spanish, Chinese. Daniel LaCalle, welcome to the show this morning. How are you?
Thank you very much. Always a pleasure. Thank you for having me.
So you recently wrote an article that was, this was on September the 28th. So that you wrote this article. It's called Welcome to the Age of Perennial Crisis. And it really kind of struck home with me because, again, as we kind of look around the globe as we speak, there's so many kind of competing theories at the moment. On one side, we've got this bullish kind of thesis in the markets, which is everything's fantastic. AI is going to be the game changer. We've got markets rocketing to all-time highs. And really just from a kind of an investment standpoint, you can throw money at anything right now and it's going up in value. On the other side of this, we have these arguments about, de-dollarization, the decline of the Western civilization. We've got these political dynamics that are happening globally. Just recently, we just saw this loss of confidence in the French government. We just saw a very interesting person elected to be the next prime minister of Japan, who has a very interesting view on liquidity that ran a shake through the Japanese bond markets in particular. So, it seems there is a disconnect, in my opinion, and feel free to disconnect with, to disagree with me, but there seems to be a disconnect between what the markets are suggesting is going to happen, but what's really happening on a global basis. And this idea from your article of this perennial crises, that really seems to be more of the case because every time we turn around, there's some kind of crisis that's brewing afoot.
Yes, I think that you're absolutely right, that there is a huge discrepancy between very optimistic expectations of global economic growth and what citizens live on a day-to-day basis. But when we look at less headline figures, GDP, CPI, etc., it's pretty evident that what is actually going on is that what we're living is in an age of secular stagnation. We're living in an age in which there's always this alleged promise that a new stimulus package is going to bring a certain level of productivity growth, a certain level of job creation. But ultimately, what ends up happening is that citizens, the average citizen, the middle class is getting poorer. Persistent inflation, real wage growth remains either negative in most developed economies or rising very little in case in the United States. So if you think about it, all of this ties together if you look at it from the perspective of a monetary world that is completely out of control, that despite the messages of central banks of being relatively hawkish, they are exceedingly dovish. Money supply growth is absolutely enormous. And at the same time, headline GDP is not driving higher economic productive growth and better real wages. So if you put it all together, ultimately, what is going on is a very simple monetary phenomenon, which is that artificial money creation is never neutral. It massively and disproportionately benefits the first recipients of money, governments, and those that have assets, i.e. the debasement of the currency, and hurts people that have real wages and people that have deposit savings. So it makes sense that high MPV monetary beneficiaries like tech stocks go through the roof, and the indices, the S&P 500 reaches all-time highs at the same time as gold is reaching all-time highs, at the same time as silver is reaching all-time highs, and at the same time as citizens say, what the hell is going on? Because I see we live in a poorer way, no? We are not getting those alleged benefits. And it's entirely that monster creation of money that has been bloating government spending, and where we see that it is basically just imploding slowly. You just mentioned it, is Japan 30-year bonds going through the roof, the yield. Lowest demand of sovereign debt from central banks in 20 years, gold demand soaring, and a fiscal crisis in the UK, in France, in Japan, and also in the United States. No.
It's interesting. I want to read to you. I'm going to read this for everybody listening. Since you wrote this, this is the second paragraph from your article. A crisis is only the manifestation of a previous excess. When governments prioritize prudent investments, healthy public accounts, and attractive taxes, crises end quickly and the recovery is stronger. Yet we're doing the exact opposite of all that globally, right? So in the United States, we're running tariffs right now. We're cutting rates. There's been 88 central bank rate cuts. To your point, as you just said a second ago, there's the monetary excess that's coming into the markets and the economies right now are enormous. And, we're seeing at the same time, dollar depression here. The dollar's been weak relative to other currencies. And of course, there's a lot of, kind of claims about this. Well, we're going to, the dollar's losing reserve currency status. There's not any real evidence of that. It's still a major part of trade, still a major part of reserves. Foreign central banks are still buying the U.S. Treasury. But the weaker dollar is certainly playing into a lot of these assets like gold, which trades in dollars. But it helps support that narrative, right, of this kind of fear in the underlying markets that of the average person. And again, to your point, to really bring what you were saying home, when you look at the financial markets, it's great. Everybody's just generating a lot of wealth. The problem is it's an illusion because it's only 10 to 15% of the population that owns the equity assets. The rest of the population is struggling to make ends meet.
Absolutely. And then it's absolutely logical that we see what the media calls polarization. It's very logical to see the enormous discontent and the rise of populist parties all over the world, because the taxpayer is losing purchasing power, is having big difficulties making ends meet. The ones that receive subsidies are not seeing any benefit, and they become a dependent subclass, while basically we're just inflating away this enormous problem of a government debt bubble. And this and it's bursting slowly. And a lot of people look at the world and looking at all these signals say, oh, we're going to have a crisis. And this is what I'm trying to say in my article, which is, a sovereign debt bubble doesn't burst the same way as a real estate or a tech bubble. It implodes slowly as it is. Sovereign debt loses value, and despite markets going up because of monetary debasement, you get bonds that are not performing, sovereign bonds are not performing. They stop being the reserve asset for central banks. As you mentioned, central banks stop or at least reduce the percentage of holdings of treasuries or of sovereign debt in their balance sheet. It's ultimately the evidence that governments in developed nations in particular have surpassed what I call the three limits, no? The economic limit, the fiscal limit, and the inflationary limit. Economic limit is that when they increase debt, productivity growth, economic growth, and wages don't get any better, they actually get worse. The fiscal limit is that despite low rates and despite high taxes, the fiscal problem remains, and interest expenses in the budget rise. And the inflationary limit is that despite talking about reducing inflation, the level of inflation is persistent and significantly above what we would call as sort of habitual inflation. So, to put it all in a nutshell, the world is realizing that the monetary destruction that we have seen in the past, manifested in the enormous level of debt that has been issued, is a problem. But the big problem is not that one. That's the tip of the iceberg. What's important is the rest of the iceberg, which is the enormity of the unfunded liabilities that governments have committed to and that need to be financed in the future, in an environment in which those sovereign bonds are not the desired low risk, relative positive return asset that they used to be.
Okay, I have questions.
Yeah.
So the thesis, I absolutely agree with the thesis, right? The thesis, absolutely correct. I have no argument with that. Here's my question though. In the world that we live in, right? We don't destroy money. Money's like energy. It just transitions form. It goes from one form to another form. And so in this scenario, you kind of touched on three things, right? So we talked about persistent inflation, we talked about kind of devaluation, et cetera. But money's got to go somewhere, right? And so right now that money seems to be flowing into risk assets, but that's a risky bet for a lot of reasons when they call it risk assets, right? So there's the first clue for you that there's risk there. It's called risk assets. But at some point, central banks, sovereign banks, sovereign debt holders, municipalities, et cetera, they've got to store their capital somewhere that has some form of safety. So from this scenario that you're painting, some debt form has to come out as the winner of capital, right? So is it going to be the Chinese bonds? Is it going to be the Euro bonds? Is it going to be the U.S. Treasury? In your opinion, where does this money finally, say, look, out of all my options, I have to store reserve currency somewhere, and where is that going to be?
Yeah. Right now, we're living in the period of the tariff tantrum and the risk-taking period in which the mirage of European debt, European or Japanese debt looked like a good opportunity, but that is exploding everywhere. So that's why, precisely for what you say, why I think that you're not going to see de-dollarization or the loss of the US dollar as the world reserve currency. Because with all of the enormous challenges that the US dollar has and the US economy have, which are obviously undoubted and discussed very, very in detail and rightly so by yourself and so many other people, despite all of that, we have to remember the rest of the iceberg. And the rest of the iceberg in France, in the UK, in Japan is 5 times bigger. No? So ultimately, what we see is an environment in which all fiat currencies are losing purchasing power relative to gold. But if you look at it in a shorter period of time, you have these big chainsaw type of moments in which it seems that the euro, it seems that the Japanese yen, it seems that the UK is going to be slightly better, and then it manifests as worse. So in the fiat world, I think that the US dollar is going to continue to be the reserve asset. But the problem is that it's not the reserve asset that it used to be in every central bank, not just the US dollar, but the euro or the yen. When a lot of people are talking about how central banks are purchasing more gold, which is true, and reducing their holdings of US debt, it is true. But what they're not telling you is that they're also not reducing, but slashing their ownership of euro debt and if they had any Japanese debt. I don't think that there was anybody, but their use of their holdings of euro debt. In fact, the first currency that stopped being that lost ground relative to gold was the euro, not the dollar.
Right. So this kind of brings up an interesting question, though. Cryptocurrencies have obviously been, kind of making a forefront as in terms of a lot of the speculation is that, this is going to be the next reserve asset, et cetera. The problem with cryptocurrencies in general, but specifically Bitcoin and say Ethereum, but primarily Bitcoin, is the volatility risk for central banks. If I'm holding a reserve currency, again, I think we need to step back for just a moment and explain reserve currencies, for our listeners so that they understand this, is that as a foreign central bank, I have to hold dollars in some form to basically offset currency exchange risk for trade. That's all I'm doing. And the dollar is weaker right now relative to other currencies. And this is an important point to discuss, which is the dollar doesn't get weaker by itself. It's weaker relative to something else.
Exactly.
And then, so as a foreign central bank, I need to own dollars for trading purposes. So I have kind of three choices to store my reserves. I can buy U.S. Treasuries. I can buy gold because that trades in dollars, so it's effectively a dollar reserve holding. And the thesis is that at some point I could use Bitcoin. I think the risk that runs for Bitcoin, at least in its current form, we're not talking about stable coins yet. You can certainly address stable coins, is the volatility risk as a reserve currency holder, of Bitcoin. Your thoughts?
No, absolutely. But there's another important factor. The reason why central banks are more than reluctant to hold Bitcoin is because if you want a reserve asset, you're looking for something that provides not just a reserve of value, but stability. It's very important, this thing. It provides stability to the liability side of your balance sheet, which is your currency, the emerging market currency, whatever the country is, no? So Bitcoin, because of the volatility, doesn't provide the stability that those central banks may require. There's another element. Bitcoin is great. I'm not questioning Bitcoin from a perspective of many other things, but from the perspective of being a reserve asset for central banks, it is basically like being McDonald's and holding vegan positions. If that makes any sense. Why? Because if a central bank is a liquidity provider, Bitcoin goes against everything that a central bank is. Therefore, a central bank holding Bitcoin is basically like an arms dealer holding olive branches.
Right.
It makes no sense. So the ultimate problem for a central bank is not just the reserve of value, which obviously includes the volatility and the enormous challenge of providing stability to the currency, but also the fact that one of the things that you can do as a central bank with those dollars is to liquidate them and move them rapidly in order to address imbalances at the currency level in each of those countries. You cannot do that with Bitcoin, no?
Right.
Well, therefore,
go ahead.
Or not yet.
Yeah. Well, and again, setting aside stable coins, one of the interesting dynamics of stable coins is they would be backed by treasuries, which would provide another bidder for treasuries if that would become the case, which would potentially be an ideal situation for a reserve asset. But again, you're buying a cryptocurrency that's backed by treasuries. So you're buying you're buying treasuries for lack of a better term.
Yes.
So the bank just says, why don't I just buy the treasuries and I get the yield on the treasury?
The stablecoin argument is much more interesting from the perspective of think about it, where we are right now. Central banks are at a crossroads in where those central banks of developed markets find that global central banks prefer gold, that the level of real returns of bonds are not giving that level of confidence to investors, etc. So there are two choices right now, only two. One, the European Central Bank wants to go massively and rapidly into the experiment of the digital euro, which is basically trying to impose the utilization of the currency and obviously the sovereign debt via different means, but imposing it instead of earning it via confidence, which is the way in which it works right now. No, and the other one is what it seems to be the idea behind the stablecoins position from the perspective of the U.S. administration. They see it's a great way of strengthening the bid on treasuries and at the same time forcing the administration to be fiscally prudent. So those two visions are colliding right now. And obviously, I have my preference, but I think that Bitcoin and cryptocurrencies are going to be in a parallel universe to fiat currencies. I don't think that they're going to mingle. I think that they're completely separate. People that don't want central bank exposure, people that don't want government debt exposure, people that are not interested in the so-called social use of money, i.e. expansion of credit, etc., are going to look at cryptocurrencies as a decentralized and unconfiscable asset. However, I think that fiat currencies will continue to work in an environment in which those cryptocurrencies actually work the way that central banks should have worked and stopped doing so a few years ago. Central banks should be actually the defenders of the currency, the ones that provide stability to the currency, that control inflation. And what does controlling inflation mean? Controlling the fiscal imprudence of governments. The central banks have stopped doing that, right. The major central banks. So in a way, cryptocurrencies and gold are those that actually set the limit of fiscal imprudence in governments. But it's obviously a new paradigm, completely different.
Right. And this brings up an interesting question that, just as you were talking, I was thinking about this, is that, if we look at the governments, global governments, and really this has become an issue really since 2008. I really don't remember that. Maybe I'm mistaken. Maybe you'll correct me, but I don't remember global governments kind of as unhinged, to use a word, as they have become since 2008, where, post the financial crisis, we've seen this kind of global overreach by not only central banks globally, but also just governments in general, spending, the debt issuance, the programs they've engaged on, social engineering. I mean, you can kind of go all the way down the list. It's been this grab, this really kind of this grab for power on a global basis. And one of the things that you're implying here is that Bitcoin and gold could strip away that control from governments. And then that brings up the inherent question: at what points do governments step in and say, we're not willing to give up that control, we're going to impose legislation, or we're going to ban certain things? I mean, we've banned, we've put bans on things before. Does that become a risk at some point for cryptocurrencies in general?
It does. Cryptocurrencies is more difficult because being a decentralized asset, they're very difficult to confiscate. No,
right.
But absolutely, the ultimate goal of a central bank digital currency is to be able to impose the utilization of the currency and penalize any other type of investment in alternatives through different forms. No. If you get your salary in a central bank digital currency at the central bank and decide to use part of your salary to invest in cryptocurrencies, and the central bank obviously doesn't like that, it can penalize you by wiping out your account.
Nice.
Which sounds like, oh my God, crazy science fiction, but my friends, it is in the fungible and modifiable part of the engineering of a central bank digital currency. So obviously they're going to try to do that. What is the problem? The problem is that my personal opinion is that ship has sailed. is that the level of confidence in the independence of central banks is so low everywhere, not just in the United States, but everywhere, because they have always erred on the side of government spending.
Right.
Always been there to be the liquidity providers of first resort, and governments the modifiers of economic cycles of first resort. That is a huge problem, because as you have rightly said, in 2008, governments found out, oh, this is the magic wand. We can spend all that we want whenever there is a so-called crisis, and no one's going to tell us anything because there's going to be a central bank purchasing those assets, and on top of that, investors are happy because stocks go up. No, the problem is that worked in a very short period of time relative to history, and it stopped working in 2022. In 2022, what happened was that suddenly, and they haven't recovered yet, the aggregate bond indices of sovereign issuers collapsed, and they've basically been treading water since then because of persistent inflation. The big problem was that we were repeated over and over. You and I have had this discussion, but they were repeating over and over, oh, we have found the way to massively create new money supply without any risk of inflation. Well, thank you very much. It lasted for a very short period of time, not even 10 years actually, and with a lot of fiddling about with the calculation of CPI. Right. So I think that the problem is that I don't think that governments have the confidence, neither do central banks right now, by which citizens would gladly accept taking their salary and having their account at the central bank.
Right. So, and again, there's an interesting, again, as you're talking, I'm thinking about, okay, this makes sense, and there's a consequence for this, which is if you remove the ability, and so what we're talking about here is removing the ability of central banks and governments to intervene into financial markets, which they've done so, and I shouldn't say just markets, the economy in general, right? We send checks to households in the U.S. We've done massive spending programs, massive bill issuances, et cetera, to help support economic growth, and it's worked. But the problem is if, as you imply, we kind of transition to a system that says, okay, we're going to take away that ability, all of a sudden, the ability for central banks and governments to control crises loses control.
Absolutely.
And the impact to the average citizen of the world is not going to be great. Will they? And at some point, are they going to come back and start begging for governments to go back to do please go bail us out again because it worked before?
I don't think that it's likely to happen that way. That is the risk, obviously, uncontrolled inflation. The other problem of the way in which the economy is working and the creation of this secular stagnation process is that it's also deflationary, i.e. that if it wasn't for the crazy, we have persistent and elevated inflation today, but if money velocity was actually going up, i.e. investment and credit were rising as fast as money supply, then the level of inflation that we are having right now would be even higher, no?
Right.
So when does this crack? When this cracks precisely when citizens, instead of going to governments and saying, please bail me out, they go out to governments and say, please disappear. Please go, because I don't like you at all, no? Which is, if you think about it, think about what's happening in France.
I was going to say, we're kind of seeing that in France right now.
Exactly. A country that has never had austerity, where governments have always gone up and up and up and up in the so-called welfare state. Yet citizens are saying, no, I don't want any more of that. The I don't know how many prime ministers they had in the past year. The next one is likely to come and say, oh, and we're going to give these subsidies. And people say, no, thank you very much. Please leave. We don't want you anymore. That is what is changing. I think that the ship of the government is going to bail us all out and we're going to go full socialist and full MMT, that sailed in 2022.
Yeah, and yeah, I think people got a taste of that, and they go, "This was great for a moment, but I didn't like the outcome."
Exactly. People thought, "Hey, they're giving me a check.
Mm-hmm.
They're giving me a check. Wow, I have a furlough job. A furlough job means that I'm being paid and I'm watching Oprah and reruns of Friends all day." No,
right.
And then very more importantly, a few months later, oh my God, groceries are up 10%, 20%, 30%, 40%, i.e. And the great thing about this is one of the greatest things about the monetary world is that it does not even matter that the government and all its agencies and all the mainstream economists and media repeated over and over and over again that inflation is because of, I don't know, the war or because of supply chain disruptions or this and that. People, and rightly so, always blame the government on inflation, and rightly so, because it's the government that creates that inflation by printing, i.e. spending and increasing debt. No,
right.
So I don't think it'll work. You see, if the next time that there could be a situation like the 2020 period, people are going to be exceedingly suspicious about government handouts.
Right. Well, and again, are we not kind of seeing the same thing in Germany right now too? I'm kind of just wondering how long it's going to be before we start seeing exactly what we're seeing in France happen in Germany. It seems that they're getting to the point of kind of their last leg of this spending cycle that they're on.
No, Germany actually has not invented anything. Germany is following exactly the same policies that France followed 15 years ago, saying that would generate phenomenal growth and phenomenal productivity improvement. And obviously it didn't. So obviously we always use this joke in the European countries. One says, "I come from the future." No, the French are the future of the Germans.
Gotcha.
And we are seeing and the rise in discontent and the rise of whatever you want to call it, nationalists, populists, whatever you want, but people are saying no, we don't want you to disguise the immigration, the demographic, the productivity, the industrial manufacturing jobs going down the drain because of the wrong energy policies, all these things. Germany completely destroyed its exporting industry with the wrong policies, all these things. You're not going to disguise that with government spending and printing.
Right. Does something you and I talked about a long time ago, and we always knew it was going to be kind of a long-term kind of train wreck, but Germany and France, they're two of the biggest contributors to the IMF for the Eurozone model, right? So when the Eurozone was created, pretty much Germany and France are funding most of that from their GDP. With what's going on in both those countries, is the Eurozone at risk of kind of coming apart at some point? Because at some point it would seem to me that Germany or France or one of these other countries would go, you know what, I need to return back to being able to control my own currency. Rather than being tied to this euro, I need to be able to, print the franc or print the bund or the franc or the Deutschmark to, fund my spending, whatever it is. And then that obviously starts to pull at that thread of that European Union. Is that potentially a risk we're looking at some point?
It's a distant risk. There is a trend in Italy that is not mainstream and certainly not gathering a tremendous level of support about it would be growing much faster if it didn't have the euro. Fundamentally for one reason, the euro area is comprised of a very aged population that remembers the peseta, the lira, the drachma, and the franc, and everybody knows that, or at least anyone that doesn't have crazy delusions, that if Spain, Italy, or Portugal had the peseta, the lira, or the escudo, the level of inflation today would not be 2.2%.
Right.
Would be 9.6%, 9.8, 13%. Huh? I'm Spanish. Huh? My first mortgage, I got my first mortgage at 13.8%. Why did I get my first mortgage at 13.8%? That shows my age and the type of inflation that we had.
That's right.
So,
mine was 12, so we're right there together, my friend.
Our age. Oh my gosh.
Yes.
But anyway, the point is, right now, the vast majority of European citizens view the euro as a beacon of stability that has given access to credit and stability in the purchasing power that is significantly better than any of the alternatives. That right now, however, if the European Central Bank plays with that and ignores what made it the most successful monetary experiment in history, the euro, and decides to abandon the inflationary limits and decides to go full throttle to disguise the French imbalances with monetary experiments, then all bets are off.
Right.
But
Well,
obviously that is not going to happen in a couple of years.
Yeah, and that was kind of my point with Germany, is that they're kind of engaging, as you said, they're following the path of France right now, just kind of going, their spending's just really getting out of hand here. So, again, just looking at, that confidence level at some point, does that really pose that risk? But I want to, kind of start to wind up our conversation, talking a little bit about inflation, because we did see a big jump in inflation because, and specifically here in the U.S., we shut down the economy, so we had no supply. We gave people checks to spend, so we had massive demand, and you obviously got inflation, right? You couldn't get anything, and so anything you wanted to buy, price went up. We've been seeing that reverse now for the last couple of years. CPI has come down to below 3% and is working to trend its way lower over time. But some of the things that we're talking about in terms of debt issuance, not just to mention global debt in general, but also demographics, those type of issues as well are playing into this, that are more disinflationary in nature than inflationary in terms of slower economic activity. And going back to the stock market we were talking about earlier, the market's betting on an economic resurgence next year to support these forward expectations, and not just in the U.S. It's in Europe. The emerging markets are all-time highs. The developed international markets are all-time highs. And when I take a look at global GDP and take a look at the economies of Germany, France, and taking a look at how rapidly central banks globally are cutting interest rates, it doesn't suggest that economic growth is going to be resurging next year, which is more disinflationary than inflationary. Your thoughts?
I completely agree. With you. I think that the biggest risk for 2026 is not rising inflation, but a very significant reduction in the inflationary burst coming from a stagnant economic growth. Obviously, you have mentioned the most important factor why we are now seeing expansion and upgrades of GDP estimates. 88 central banks bringing down rates. We've had the biggest period of monetary easing, while at the same time, money supply growth is faster than GDP growth. So obviously, GDP is better than was initially estimated last year. But next year, you have a big problem, because all of those tailwinds of lowering interest rates, money supply growth, and government stimulus packages are going to wind down or provide a much lower level of productivity growth. So I think that the biggest risk in the market right now are those sectors that depend on the economic cycle to justify their valuations, because it makes absolutely zero sense to look at forward estimates of earnings in Europe, in the UK, in the United States, and expect that next year and the following 26 and 27, you're going to get 3 times higher earnings growth than in 2025. No,
Right.
so I think that the biggest risk on the most cyclical and the most exposed to this, let's say, tailwind of money supply growth and low rates.
So and this kind of, I'm going to kind of switch gears here just a second, because obviously the big driver here in the States right now is everything AI, right? It's artificial intelligence. We've got, I just wanted to get your thoughts on, kind of what's going on with AI, not just in the US, but what you see in Europe in terms of AI development and those type of things.
Yeah.
And here's, kind of the interesting thing, so right now we have this big kind of circular dynamic of the three stooges, kind of each paying themselves with the same money. And so we're just moving $1 to the next guy. OpenAI invest in Oracle, Oracle invest in NVIDIA, NVIDIA invest back in OpenAI. And it sounds great. This is all future revenues, very reminiscent of what we saw in the late 90s. But when you think about the requirements, so for instance, the recent Oracle deal, it's going to require 2.5 Hoover dams to power the AI data centers that Oracle is committing to, which we don't have that. It's going to require 4 nuclear reactors, which we don't have, and they take basically 10 years to build. Even if we can fast track them, it's 5 years to get them built. They just take time. But when you move this to Europe, they have much bigger power issues than we do in the United States. They made Germany is a good example, made this massive move to try to go to green energy. That's really starting to, and they've become very dependent on Russian natural gas. That's really starting to bite them in the butt. Well, how are you going to fund the power development to facilitate this AI development that everybody's banking on? It seems to me that power is going to be the biggest issue for AI in the future than it is right now.
Absolutely, it is. Absolutely, it is. So what you will likely see is a process of over-allocation and misallocation of capital that is very typical of big industrial and technological revolutions, no? And you will have, and the most important driver is where you're going to have the incentives to invest in that power capacity relative to where you have the disincentives. So the other day, the European Parliament was talking about all these things about AI, and nobody was talking about power, no? And I was mentioning with a group of industry friends, etc., saying there's going to be this enormous vacuum of capital allocation that is going to go to the United States because the incentives are better, because the facility and the ability to build at least a significant part of that power capacity is higher. And it's going to leave the European Union. But how are you going to do it? It's impossible to do it, no? So it's a huge, huge, huge problem, because China is already betting on an enormous amount of energy that is going to, and that's why it's trying to secure every supply of energy possible, from coal to natural gas, nuclear, hydro, renewables. It doesn't matter. The United States is likely to continue to drive investment to its shores because capital moves capital, and at the same time, the possibility of building that power capacity may take 1 or 2 years. It's not going to take 20. What is the problem in the European Union? The problem in the European Union is that regulation is so out of control that it's not even a question of the ability or the capacity to do it. Is that you cannot even start to do it. So a lot of capital is going to flow out of Europe and out of similar economies with excessive regulation to power the AI revolution. And obviously, all of the power that is currently expected to, this reminds me of the shale revolution. In the shale revolution, everybody was saying, oh, it takes way too much energy to produce this amount of oil. Therefore, it's going to be impossible because of the unavailability of water and the unavailability of energy. Well, the incredible thing is that you will likely have, like in the shale gas revolution, in the AI revolution, a very rapid solution in terms of efficiency within the United States, but capital is likely to flow out of the European Union and into the United States, because China it's in another planet and in a different let's say race. So that is the danger, is that the European Union is not only burdened by the enormity of the regulatory burden, but because of the impossibility to make the capital allocation efficient, rapid, and profitable.
We've been talking with Daniel LaCalle this morning. Thank you so much for your time. It's been a great conversation. I encourage you to go to his website, dlacalle.com. It's spelled LaCalle, L-A-C-A-L-L-E, but dlacalle.com. You get all of his blog posts, links to all of his books. It's great reading. It's a great research tool for you to really kind of understand what's happening, not just in the U.S., but on a global basis as well. Again, Daniel, thank you so much for your time today. We really appreciate it, and I look forward to having you back soon to catch up with what's going on in the world as we get into 2026.
Absolutely. Looking forward to it. Thank you very much, Lance. I thoroughly enjoyed it.
Thank you. That wraps up our Real Investment Show interview podcast for today. Be sure and get by the website, realinvestmentadvice.com. Be sure and like and subscribe to the channel. It certainly helps us get more of these interviews to you. Like and subscribe to the channel today. Also get by the website, realinvestmentadvice.com. We'll see you back here tomorrow for the next edition of the Real Investment Show.